So the three-legged stool is becoming the spaghetti monster as we continue on with our discussion here, because now we're going to talk about the private insurance market and how the folks at Ceres are looking at climate modeling and how that might play into their market. So here we have Cynthia Mchale. She's the director of the insurance program at Ceres, and she has amazing experience in working with insurers, reinsurers, and industry brokers.
Thanks. Good morning, and thank you for having me here today. Make sure I've got my clicker going. So my comments are really going to focus on climate change and those climate risks that relate to the private insurance industry. It's a very significant player in this whole discussion. I'd really like to take 20 minutes or so and focus in on that. But first of all, who is Ceres? So Ceres, the organization I work for, is a not-for-profit. It was formed in 1989, so we're celebrating our 25th anniversary. We were created following the Exxon Valdez oil spill. At that time, a group of investors decided that businesses were not doing enough to account for their environmental impacts. These were large investors, and they decided to come together and exert the power of the investment community on private enterprises to be more responsible. Ceres' mission today is to mobilize business and investor leadership to build a thriving and sustainable global economy. We also manage the investor network in climate risk. That includes about 75 major institutional investors with something like 13 trillion in assets under management. They're very, very concerned about how their investments may be impacted by climate change. So, whoop, lost a, there we go, maybe I got it here, there we go. All right, so Ceres insurance program in particular, why do we care about the insurance industry so much? We are unique in the NGO world, focused specifically on climate risk and resiliency issues related to the insurance sector. As you would imagine, insurers have a huge financial stake in society's awareness and understanding and reduction of risks to property, human health, and our future economic vitality. They are in the business of risk. That's what they do. And when they don't feel they can manage risk or understand the risks that they're underwriting, they usually end up losing a lot of money. The insurance sector also provides very significant indicators of the actual costs of climate change and its destructive potential. And we'll get into that in a little bit more detail. Insurers also, as we've touched on earlier, provide very clear and direct price-based incentives to policyholders, both commercial as well as personal lines, to motivate risk reduction and investments in resiliency. And last, but very significantly, and I'm not sure this is something that everyone always thinks about, but insurers themselves are major institutional investors. On a global basis, the industry has around $28 trillion in assets under management. They're the largest category of institutional investor, and we're very actively today trying to mobilize them to themselves be investors in clean energy and climate adaptation and resiliency. So let's just take a look at this. Many of you may have seen this graph. This one is by Munich Re. Swiss Re puts one out as well. This is for the United States for a 30-year period, actually a 31-year period, 1980 through 2012. You can see there the total losses. These are in US dollars, billions, and they are, the inflation has been adjusted already, so these are constant dollars. The top of the bar are the total losses on impact, not longer term, but on impact from extreme weather events. And the portion there, the darker blue portion, is the amount that the insurance industry is covering. So you can see clearly the industry is paying more, everyone is paying more. The spike there in 2005, of course, is Hurricane Katrina, Wilma, and Rita all hit in 2005, and a huge spike there. So you can see insured losses in the United States have been trending up. Very significant, though, this gap between what the industry is covering and what all the rest of us are picking up. And by all the rest of us, I mean our federal, our state, our local governments, as well as individuals. Many losses are simply not insured or covered by any of those other buckets, and we pay out of our pockets for them. So what's causing this? It's really a confluence of higher concentrations of people and property. You can see there Ocean Drive, Florida in 1926 versus 2000. This is happening all up and down our coastlines, as you probably know. We've got concentrations of people, values that are concentrated, and we have sea level rise and more intense and frequent extreme weather events. The trends, I feel like saying we haven't seen anything yet. We know we're just starting to see the impacts of climate change. We know that those are going to become a lot more significant going forward. So we take here a situation with Hurricane Sandy. It focuses on the area where Sandy came on shore, New Jersey, New York, and Connecticut, where they experienced the highest storm surges. When we think about redefining risk, we want to think about the resiliency of our infrastructure, especially, and the sort of cascading impacts of a superstorm Sandy. So for example, on October 30th, 2012, the Brooklyn Battery Tunnel was flooded from a tidal surge that was caused by Sandy when it came on shore in Manhattan. Transformers exploded after a wall of water defied elaborate planning and swamped underground electrical equipment in an Con Edison substation. About 250,000 lower Manhattan customers lost electricity, and without electric power, no public transportation, and extensive flooding of businesses, the New York Stock Exchange closed for 2 days. It's the first time it's been closed in 27 years due to a weather event. So we use this. This is really what the insurance industry uses when they think about risk. It's a pretty, at a high level, straightforward equation. It obviously gets very complex, each component of it, but hazard, so you've got wind and storm surge times exposure, the buildings, roads, and tunnels, times vulnerability. We know we have hazards that are going up, we have exposures that are increasing, and we have a lot of vulnerabilities today. Those vulnerabilities are also going to be increasing going forward. So I won't drain this slide. I think, we can look at all of these numbers. You can see clearly that we are not prepared today for climate change. And can we even realistically protect ourselves going forward? It's a serious question. It brings a lot of different dimensions of how we build, where we build, what we invest in going forward into question. So climate change is certainly something that, especially the reinsurance component of the industry, is looking at very closely. For example, with New York City, after Superstorm Sandy hit, there was a very significant undertaking to understand where New York City is vulnerable and determine what sorts of investments were required. This really started with Swiss Re and a number of others working with the city to start to get their hands around the magnitude of the risk facing New York. And this was done in light of climate change impacts. Their analysis is called the economics of climate adaptation. This is just one component of it that I wanted to highlight to you. It's a very rigorous, very quantitative type of review. Under the current scenario, what they found is that on average, the annual damages to New York City today are 1.7. These are in US dollars, billions. If we take the sort of current environment, no new buildings or bridges or anything, out into 2050, what are the average annual losses with climate change fully sort of taking effect at that stage? what they saw is that it goes from 1.7 to 4.4 billion. It's about equally attributable to the impacts of sea level rise in New York City area, as well as additional impact from increased frequency of intense hurricanes. So those two components are driving a 168% increase in the average annual losses to New York City. That doesn't mean that amount will happen every year. That's just an average. Some years will be much higher and some will be lower. But when you start to think about just New York, and then you think about all of our coasts, from the Gulf to Florida, all the way up to Maine, as well as the Pacific coast, you start to, it almost becomes hard to sleep at night, to be honest. We clearly have a major challenge on our hands, let's say. So one of the other aspects of quantifying the expected losses, they took those figures and drilled them down to a zip code level. And grant you, it could be much more granular than that. That could have been done at a parcel level. But this is at a zip code level. You can look and see today. It's a little bit hard to read, but where the dark blue areas are sort of showing up today versus 2050, that's where there is the biggest increase in average annual losses. So pretty much what you would expect there. Where we're seeing flooding today, it's going to be a lot more severe. Areas such as east and south shores of Staten Island, southern Brooklyn, South Queens, the Brooklyn-Queens waterfront, southern Manhattan. It crosses a broad spectrum of commercial areas, residential areas, high density, where a lot of people and economic activity occurs. So one thing I want to mention also, what these quantitative analyses show us are the dollar losses. They don't show us the impact to more vulnerable populations. Some of the other very important sort of human dimensions that need to be taken into account when we're thinking about investments in resiliency. This is really just on an economic loss basis. So now that we're sort of at the depths of despair here, the next part of the work that they've done, and this was actually from a very similar analysis that was done in the Gulf Coast. It's really, they've done these in a number of different areas, but looking at some of the ways to most cost effectively increase resiliency. Excuse me. So we've got a number of different categories here: residential and commercial, infrastructure, oil and gas. That has to do again with the Gulf Coast. And electric utility, looking at a whole portfolio of ways to both green and gray measures to build resiliency, and then running those through these cost-benefit analyses. What we can see there is that some measures are quite cost-effective, others not so. So where we have, generally speaking, ECA analyses above 2, that is, projected costs are twice as high as the projected benefits, less likely to undertake those, unless, again, there are other reasons. Perhaps you have a very important structure there, such as a healthcare facility. That always needs to be running. You're going to make those additional investments. So again, though, I guess the takeaway here is that once we know the magnitude of our losses and where we're exposed, and then looking at a whole portfolio of options and really analyzing those carefully. You can see these ECA analyses have been done in many different parts of the world, in both developing as well as developed countries. I think one of the things that is significant here is that 40 to 65% of losses can be averted cost effectively. You still have residual risk, that is, where it's too costly to invest in those resiliency measures, and that's really where the private insurance and sometimes public insurance plans will come in, and where it makes sense. And you need to have functioning insurance markets. That's an issue. When the private insurance industry pulls out, that's really a problem for a lot of us. One of the things I also always notice about this is annual loss, expected losses as a percent of local GDP. You can see that in the high GDP countries, the bars are not as high as in the low GDP countries. And I just want to emphasize, it is hard as it is for us to deal with the risks that we're facing. It is that much harder excuse me, for people and countries that have nowhere near the resources that we do. They are, in fact, much more vulnerable to the impacts of climate change. So let's see, just talking a little bit about the insurance industry. What is their role? There are a lot of ways that the industry can make a difference here, and that is really my job, is to act as an advocate, to work with the industry, to motivate the industry, to get shareholders in the industry to get off the dime and start being part of the solution. You know, where there are risks, there are opportunities for this sector. They can certainly develop more climate responsive products and services, promoting loss prevention and adaptation, helping out with the design of newer building codes, land use practices, vulnerability assessments, as you saw with Swiss Re, and in fact raising awareness and educating all of us about the risks of climate change. And we are very much pushing the industry around a commitment to a comprehensive response. In fact, we're coming out with an industry scorecard in September that looks at the entire US insurance industry and, in fact, scores every company along a number of climate change dimensions in terms of how well they're doing. So I'm just about at the end here. On a good news note, I would like to let you know that just under a month ago in May, the Geneva Association, which is the insurance industry sort of think tank, announced this climate risk statement. 67 of the leading insurance company CEOs have signed on to this, which is an incredible development. They confirmed the Kyoto Statement, which is critical. They're confirming the climate science. And I have to tell you, this is an industry that in many ways has been sitting on their hands. I think this is an indication that climate change is becoming mainstream. I will also add that we need more US insurers on that list. There are some, like AIG and Berkshire Hathaway, Warren Buffett. We need more of the US industry on that list and signing up. So just to wrap up here, we, as I mentioned, working a lot with the sector. We have been running a number of workshops where we bring leading insurance companies into discussions with communities, primarily with some of the larger cities and real estate developers and property owners, to define priorities for collaboration on building climate resiliency. These are the sort of set of priorities that came out of those discussions. We had our first convening here in Boston. We were then in San Diego and last in Toronto. So I think this is good. I mean, we have a big industry here who has a lot of influence. They have, this group has committed to these priorities around increasing physical resilience to climate change, collaboration among different stakeholders, organizing collaboration at the asset or local area also requires new approaches to governance. And one of the issues there is that if a building undertakes measures to make itself more resilient, that only goes so far. One also needs to make sure that the environment around the building is also more resilient. Action at the local level can enable more effective action at the asset level. And then sort of the visionary leaders can give their cities a competitive edge by combining actions. We talk a lot about the fact that cities that invest in resiliency early on will be the locations of choice for business investment and places people will want to live. And then developing a sort of standardized resiliency rating may be an effective way to support cross-industry practices. Sort of the thinking is like the LEEDS rating, where we're able to measure and communicate the level of resiliency of a building or a community or a city. So that's it. Those are my remarks. I tried to cover a lot of ground there, so be very happy when we get to the Q&A to answer questions you might have.